Good morning. Welcome to Trading Hour. I am Reema Tendulkar. With me are Pavitra Parekh and Sumaira Abdi, and markets are in a fine fettle. We had a gap up opening. We built on it. There's been a spring in the step in the last 30 minutes. There you can see we're at that 17,523 mark. We've crossed the 17,500 mark quite comfortably right now. And if you look at last Friday's close, before the big slam dunk which took place on Monday post the Jackson Hole meeting, the Friday's close was 17,558, which means we're just about 30 points in recovering all of yesterday's losses. And that just is a pretty good trend for our own market. So quite upbeat, and considering the Brent crude prices too have inched up to levels of $104 per barrel. Asian markets are mixed. Nikkei and Korean markets are upbeat. They've got a gain of close to about 1%, but Hang Seng and Chinese markets are struggling a tad bit. Talking about Asia this morning, Korean markets, there's been an important update from there. South Korea has cut the government budget for the first time since 2010. This is a move to reduce the pandemic-era spending as well as curb inflation. So the 2023 annual budget for South Korea will be lower by 6%. So inflation is hitting every part of the world. And South Korea, the central bank in South Korea, Bank of Korea, has already raised interest rates by 200 basis points since August last year. And this is another measure that they're taking to bring down inflation. So next year's annual budget for South Korea has been lowered by 6% compared to this year, marking the first budget cut in more than a decade. So it's hurting everywhere.
Oh, absolutely. But, you know, right now, considering the kind of global handover that we got, of course, today is looking like a really good looking screen for our own markets. And even since the start, it has only moved higher, right? So right now we're at the day's high. The stocks and sectors which are doing well, auto, like we've been pointing out to you for the past many weeks, is sort of in a bull market of its own. Even today, it's up 2.3%. The real estate index is actually the top sectoral gainer right now. So that one will also be up for you. Just some of the larger names which are doing well will be up on your screen. So something like a Maruti, you have Bajaj, all of these faring quite well in trade. And the real estate stocks also will, of course, come up. So something like a DLF is up over 3%. A lot of the smaller auto names, I've got to point that out earlier, but something like an Igarashi Motors, that one will come up. Atul Auto, look at the kind of moves that you're seeing on these. So across the board, looking good for that sector. On the downside, of course, you have Reliance, which is a little bit, muted right now. You have Bharti Airtel also, which is a little bit muted. And a lot of the pharma stocks are kind of trading lower today. So that's what's happening as far as the market goes. But Sumaira, this looks like a good looking screen. And considering the fact that the global markets, are sort of did not give us that kind of handover at all.
Yeah, it's like one up day and one down day. I think we've just gotten used to good days and bad. So here's what we have for you today. Indices edge higher despite a weak handover from Wall Street. Nifty crosses the 17,500 mark. Autos, realty and metals charge ahead. Defensives lag behind. We'll talk about the market fundamentals with Shyamsunder Bhat, CIO at Exide Life Insurance.
Ashok Leyland adds 2 models to its Bara Dost range of LCVs, unveils the Bara Dost I1 and Bara Dost I2, excerpts from our conversation with Rajat Gupta, head of the light commercial vehicles business at Ashok Leyland, coming up in just a bit.
Bharti Airtel is the top Nifty loser today as rival Jio's capital commitment to 5G announced at Reliance's AGM yesterday is nearly double of Bharti Airtel's. More details coming up later on the show.
And Reliance also made a slew of other major announcements at its 45th AGM yesterday. Jal Irani of Edelweiss Financial Services, as well as Shirish Pardesi of FMCG and the FMCG analyst at Centrum will both join us to discuss the key takeaways.
And later on the show, we'll also get you excerpts from an interesting chat with Nadir Godrej, chairman of Godrej Industries, in which he talks about demand trends, inflationary impact, and the outlook ahead. All of this and much more lined up for you over the next 60 minutes.
Shyamsunder Bhat, the CIO of Exide Life Insurance, is now here with us to talk about this big recovery that we're seeing in the markets right now and what the setup is. Mr. Bhat, morning, and thanks so much for joining in. This is Reema here. That's the first question, right? It's so hard to gauge the market. Suddenly, yesterday, we had this big drop-off, and even in the U.S. markets, now the recovery. How would you assess the market right now at this juncture and the probability of the direction in which we are likely to head?
Yeah, thanks. So good morning to everyone. So as you said, intraday moves clearly are being extremely difficult to gauge and predict. But if we see the broader outlook clearly from the longer term perspective, the relative positioning of India has been getting stronger in the last few months, particularly from the perspective of the relative growth that we are likely to see versus other countries, as well as the relatively lower gap between inflation and interest rates that India now has as a country. Uh, but in terms of the near-term outlook, we remain cautious. Clearly, the strength in the market is a bit surprising. The up move or the bounce back in the last 2 months was not as surprising because there were quite a few pockets of the market which were undervalued at that time. But at the present juncture, there are very few pockets left in the market where the valuation upside for the next year or so has not already got captured. So from that point of view, the safety or the cushion of safety from for the overall market, we believe at this juncture is quite low at the current levels.
All right. Good morning, Mr. Bhat. Thanks a lot for joining us. This is Pavitra. So you said that you are cautious on the market right now. And, at a time like this, when we do have such heightened volatility, perhaps the focus shifts more on just protecting your portfolio. So what would you think are good pockets to hide in and good pockets to have your money parked?
Yes, I think two factors which will help in understanding the way we are thinking about the sectors or the pockets. One is clearly that while the inflation risks are now appearing lower than what they were 1 or 2 months ago, clearly we are not out of the woods yet. Inflation is still clearly going to be a concern, maybe lesser in India, but definitely a global concern. And the global growth clearly is concerning, particularly given what is happening in the European Union and the US, and also the China growth not possibly living up to what was expected. Therefore, the sectors which are clearly dependent on a larger global growth, or the sectors which are going to be impacted by higher inflation, are the ones to be underweight on. So from that point of view, clearly oil and gas and metals, two sectors, and consumer stocks also from the India's perspective, which are impacted by higher inflation, are sectors which we are underweight on. Financials, clearly we are overweight, but we've seen the financial sector already have a good run in the last couple of months. So we do remain positive on sectors where like chemicals and agri, and some of the domestic focused names where India would be rather either insulated or will actually gain by what is happening globally in terms of partial shutdowns due to the high power costs.
Okay, hi Mr. Bhat, morning. I can imagine that you're choosing to go underweight few sectors, but are there candidates who are where you want to take money off the table entirely? I mean, are there sectors which are no longer places where you want to remain invested?
Not really. So there are a couple of sectors where we do not really, have investments presently, or we have very negligible investments. So real estate, for one, is a sector where we currently do not have an exposure. Power utilities also, we do have an exposure, but a very small exposure. So these two sectors are very negligible as far as our portfolio is concerned. But from the other sectors perspective, whatever I mentioned was from the near-term outlook. Our outlook clearly is at least 2 years plus, because that is the earnings forecast that we generally build in when we look at investments. And from that perspective, there are definitely pockets in most of these sectors also where the sectors where we are underweighted, where there is still some value. But since the market overall, seems to have well captured the 2-year earnings growth of about 12 to 13% CAGR, which we are expecting between FY22 and FY24, at close to 18 times today for a 2-year forward earnings, we believe that the safety level for the overall index per se is quite low in the near term.
Mr. Bhat, the big talking point has been the sharp rise in gas prices and the energy crisis which is brewing in Europe, and what winter is going to look like for the European region. Is there any way to play that theme in India? Is there going to be any direct, indirect impact on stocks, sectors, any theme, any correlation that you can draw to, understand from a market point of view in India how we could play or we get impacted?
Yes, so partially, so the direct impact clearly is on the gas consumers in India and the city gas companies, which clearly will be under pressure in terms of either having to pass on the full burden and therefore seeing a possible fall in demand or a shift to other fuels from some of the customer segments. The indirect benefit, yes, as I said, if there are shutdowns, particularly in the European Union of sectors which are dependent on the high energy on high energy utilization, we could see some sectors, so some pockets of metals, for example, some like aluminum, and some we may even see a scenario happening in chemicals as well. So we've been seeing news of late of what is happening in paper, for example. So these are some of the smaller sectors, but we could, if this continues into the winter in EU, we could find more of the sectors opening up for where India can possibly gain a tactical advantage in the next few quarters.
So negative on CGD companies because they may not be able to pass on the entire burden, and there is an opportunity for specialty chemicals or chemical companies and paper companies in India, right?
That's true.
Okay.
And aluminium, as I mentioned, so because we have aluminum smelters also, facing the brunt. Plus, as I said, we may find more sectors opening up in the next few months if the gas prices continue to remain high or go higher. If the crisis continues into the winter in Europe.
About auto companies, many of them have operations, manufacturing plants in Europe. Is there a risk of factory shutdowns? And is that something that the street is worried about or pricing in?
Frankly, I think the shutdowns are a news which we have just started seeing in the last few days and possibly not yet factored in by the markets.
So do you think this would be a good place to, any sort of approach to the auto stocks? Would you sort of recommend that? I mean, we have been talking about the kind of run-up that we've seen in auto names and auto ancillary companies as well.
So on auto in particular, of course, in the last few months, we've seen a substantial re-rating and most of the positives for the auto stocks seem to have got factored in. I know we are seeing a continuation of that rally today. But we would be neutral to slightly underweight on the auto sector. And from the perspective of short-term outages, it's difficult to take longer-term calls on this because unless some companies have got excess capacity now which can supply and meet the demand, unless there is a long-term disruption in the capacities in a particular geography or a sector, one may not see a long-term advantage for any of the companies in India. So this is at best a tactical kind of a short-term play for investors who may want to look at.